setting. This is Zach DeSetti. Kimberly Holder is in the background with us, kind of manning some of the technical operations in the background here. So if we need anything, we might call on Kimberly as we go, but just another 30 seconds here and we'll get started. Kimberly's going to stay with us. Just make sure if we run into technical difficulties that we don't know about, then she will jump on and bail us out. I believe, Kimberly, everyone is muted at the moment, and we will probably encourage you to, if you have any questions, maybe just jot those down real quick. Have a pen and paper handy. I think it would be good to have a pen and paper handy today too, because again, we're going to handle some of these things that are a little bit complicated. Our hope is that if they do stir up a question about your business succession plan or something that you feel like you want to discuss with your business succession plan, that you'll jot those down, and that'll be something you will be able to refer back to either privately with your advisor, whether that advisor be a CPA, attorney, or your financial advisor. But you also we'll leave plenty of time at the end of this. We're gonna, as we always do in these InfiniTALKS, we're gonna try to probably talk fairly quickly, cover the material fairly quickly, so that we leave time for questions, and we use your time efficiently. Zach, you want to give us a brief introduction? I mean, I know you and I have a buy-sell agreement together. As a business, we have to address these succession issues. You never know what's going to happen in the future, but you do know that we have a good, solid business that you want to make room for a good transition.
Yeah, and that maybe why we were asked to do this today is that we can kind of speak to this personally between each other, and really today we want to just kind of outline who and really when and what a succession or a buy-sell agreement. Those words today we're going to kind of use a little bit interchangeably, but a lot of work goes into these agreements and these succession plans. So identifying who that right person is, like in our case, it's me and you, and my youngest brother, has joined. So we'll have to take that into consideration. And for a lot of other businesses, people come and they go, but you want to identify the right people. And then how do we set that up? When do we set that up? When are those things executed? What tools do we use? There's a lot of tools, a lot of resources. You have us as your financial advisors. You have attorneys and CPAs. Some people, specialize in these areas very specifically. So there's a lot of different tools that can be used, when engaging in these agreements, and then making sure it's, executed. How do you do that properly as far as financing and so on? So those are really what we're going to kind of get nuts and bolts of what we're going to, get into today.
Let's jump right in with the first question. Obviously, who's involved. On the right-hand side of this slide, it's a pretty simple explanation. The first three of those, whether you're an owner, a partner, or a shareholder, really all those terms are synonymous. Those are terms that are just generally used to describe someone that you have a formal business relationship with. You do, in many cases, have to take into consideration a key employee. That key employee may not be a shareholder yet, but they may be involved in some kind of a succession agreement because there may be a reason to make them a shareholder or reward them like a shareholder. At the end of today's presentation, we're going to hit one quick slide and talk about just a few of those issues, whether you do or don't make a key employee a shareholder. And then there's the fifth one, which is family members. We're fortunate that we get along really, really well, so we can smile and joke about it. But when a buy-sell agreement or a business succession plan involves family members, it brings up complexity because of the family member being a shareholder, but it also brings up that complexity of a shareholder when you have other children, and this is true of our family. I'll have kids in the business, and I'll have kids that were not in the business. My business value is an important part of my estate. How do I equalize? And that doesn't mean dollar for dollar equalization, but how do you equalize between your succession plan with kids in the business and kids that might be out of the business.
Yeah,
Anything you know?
yeah. I mean, a lot of the maybe more of a common term that a lot of people are looking for is the word kind of fair, right? Fair doesn't always have to mean equal, but you want, to be fair. And I think sometimes we think that we're not the only, but we're, our family business is few and far between. We hear a lot of people say, wow, you don't get to work with a father-son team very often, but I think that's actually not very true. We run across family businesses all the time. Maybe it's a uncle and a nephew, or I mean, we worked with a lot of businesses that have been passed down, all the way from grandparents now to second or third, generation. So coming across family businesses, identifying those key employees, whether it's promoting someone or making someone's responsibility, maybe a little bit more, at one of these, triggering events, which is what we're going to talk about next, is something that you just kind of have to, talk about a lot beforehand and identify.
Whether you're in a family member or a non-family member, there's a couple things I would add, Zach. One is my favorite joke. When I was young in the business, I came across a slide at a succession planning workshop 25 years ago. And the picture this, the father and son were walking through the warehouse together, and they had all this equipment, and it was clearly a business scene, and they'd made significant investments in tools and equipment. Mm-hmm. And the little quote above the father's head said that I guess it wasn't a father and son, but it was just two partners. And the father was saying, you've been like a son to me in the business, and frankly, I'm sick and tired of it. So anyway, that was always my favorite joke, but fortunately, I don't have to deal with that.
You're not sick and tired of me.
No, not yet. Right, not yet. You're doing a good job.
So yeah, we identify who, maybe is going to be in that line of succession. But, really, when do we start executing this document or start planning for this? And I would say, now is obviously the best time. But, why don't we always get to that now? We know, from personal effects, let's just take the stock market, for example. I mean, in a year like last year when the stock market's down, sometimes maybe the important things that we know are important, like succession planning for the long term, they just kind of fall to the bottom of the list for what becomes urgent in our day-to-day life. Mm-hmm. So really identifying when we need to start planning for that now. It's one of those things that we just kind of have to gear up and start doing, because really we all want to plan. We want to have a succession have control over. We can just easily, know that you're going to retire in 10 years from, today, and we're going to execute, the transition of the business just seemingly, but that, doesn't always happen. Unfortunately, in life, we have things like death or disability that, are sprung on us. And I think that's where a lot of people kind of get caught with, no plan, kind of in place.
A starting point, So as a financial advisor, what we use is what we call a buy-sell matrix. And we could put a graphic up on the screen, I suppose, and show you that. But it's nothing more simple than a grid. The events are on the left. You could, unfortunately, there is the possibility of dying, becoming disabled. More hopefully, you have a retirement plan and big party, over the course of that. Those triggering events on the left-hand side, and then the timing and how you want to address each of those different events. So if that's something that, if you have a buy-sell agreement and you haven't updated it in a while, it'd be a good starting point to go back and populate. We could do a free review of that plan, and we could populate that matrix so you can easily see what is our current plan in each of those triggering events. If you haven't done a succession plan, then it'd be a great starting point. Again, on a complimentary basis, we could go through and have that initial meeting with you and see what you do know and what you don't know about how you want to handle each of those triggering events.
Yeah, I think a really good statistic that we often bring up a lot of time too, and this kind of hopefully gets the ball rolling for some people, but Family Business Magazine did a study, again, on family businesses. And I thought it was a little bit surprising that only 30% of family businesses make it down to that second generation. I mean, that kind of brings it home for me, saying that that's just, me to you, right? And to take that even one step further, only 13% of those family businesses make it down to the third generation. Fortunately, we're lucky enough that we know a lot of really actually second and third family, businesses. They've made that transition, but we've also seen that that's taken a lot of work over the years, a lot of coordinating. And so again, it's just one of those things where we have to, it's not probably the most fun topic. It's not the most urgent topic, but we can not stress enough, really how important that is.
I think technically we're luckier than that because my father was in this business.
Yeah, that's true. Yeah.
So we technically could claim being a third generation business. My father was predominantly a consultant, but did have an investment securities insurance license and was a financial advisor for a period of time. So,
yeah, perfect.
Yep.
So we know the who, we know the when. I think one of the biggest things people struggle with, because a lot of times this gets into the complexity, which you're going to kind of cover a little bit on a high level, though, is having a price or kind of doing what's known as a valuation process.
Right.
You want to talk a little bit about that evaluation process? And I know we just pulled up on the screen here a couple different approaches. There's different approaches that make sense for different businesses, right? There's businesses that have assets. There's businesses like ours that we don't really have assets. We have our computer screen, but that's probably not worth too much at the end of the day. So will you kind of walk us through, some of the different approaches and what a business might be looking at?
Well, just for a little bit of humor too. I mean, from the investment side, I want to remind you clients that we have as many assets as you like to buy. So we have an unlimited supply of assets. But in the sense of our business, you're right, Zach. Not an asset-based business, but a service or an income-based business. These four particular approaches, I can say, in 34 years of being a financial advisor, I've read and helped develop hundreds of buy-sell agreements. I would probably tell you that every single one of them is slightly different when it comes to the valuation method that business used. I'm being 100% serious here. I don't know that any one of them says the exact same thing when it comes to valuing their business in terms of methodology. And the reality is, whether it's assets, whether it's income, whether it's a market approach where you have to take into consideration the type of business you're in and the type of economy you're in, the reality is it's probably a combination of all of those events or all of those styles of investing. One of the great, and this is where you're going to have to get your other professionals involved to be able to understand what the best approach is. We can be of assistance in helping you maybe set an initial idea of this, but your CPA and perhaps your CPA is a valuation specialist or can recommend a valuation specialist. If the size and complexity of your business warrants it, you really should take time to get that evaluation because number one, it gives you a fair market, for the best method and the best price of what your stock is worth today. But I think more importantly, it gives you a formula.
Yeah.
No matter how and when I said that every buy sell I've ever looked at ultimately ends up probably has a different formula to how that value is calculated.
Yeah, those are kind of the high level pieces, and then they add in. Are you a company that has a lot of equipment and a lot of assets? How do you calculate that in? Or are you more of a revenue based company? We saw during COVID that some companies had a big boom in their business, or maybe they didn't do so well. So how does the formula, which maybe look back like 3 or 5 years of revenue on a certain multiple, how do you calculate in such a outside economic factor? There's just so much to look into. It doesn't fall nicely in like on our graph is one of these four. It's one of these four plus something else.
You all can't see from behind the scenes. You can't see how many people are on this call. There are about 50 different businesses on the call today. Some are clients that I recognize. Some I don't recognize, but I'm glad you're here today. We have clients that have a business that is a manufacturer's rep business, and their contracts, I talk with that business owner frequently. Their contracts are good, this year, but maybe next year they don't have that major contract. That might be a 20% amount of their income from that particular contract. And so they don't have the predictability. That predictability factors in. We have clients that own a funeral home. Unfortunately, you can predict your business a little bit in that their services will always be in business, and you have a little bit more security in the reality of the business nature. So again, the type of business, the economy you work in, the assets you have, the income you produce, and getting a valuation, a CPA or valuation specialist to work with your attorney who can draw up that legal document. I think the big thing that you come away by investing and evaluation is that you have a formula that will be written into the agreement so that 1 year from now, 3 years from now, 5 years from now, if that formula is done well, it's something you can use hopefully indefinitely, but at least for the near 5 to 10 years, that formula should apply. Because here's what happens, and also in my experience with clients, it's a lot of work to get a buy sell in place. You do the work, you get the formula, you agree, it's good, but you really should be updating that value every year in terms of your meeting minutes of your stockholder meeting.
Yeah.
Most clients, kind of get behind on that. They have more important things versus more urgent things versus important things. And in the event of a death or a disability, something that happens on an untimely basis, it gives you something concrete to fall back on and know that you had a methodology that's going to be fair, is at least close to fair in that emotional time.
Yeah, it's the last thing you want to be dealing with, at one of those triggering events we talked about, is coming up with something that's fair to a buyer and a seller. There's too much emotion involved to be doing it at that time.
Yeah, absolutely. So I think that's the important thing to come away.
We're going to talk about two different kind of structures on how to make this who and when and everything kind of come together. On the screen on the left side are those two structures, and a lot of the times a company will use itself to back the assets. They'll use themselves to make the purchase, to kind of be the intermediary between whether it's that key man or some of those current partners or business owners, and how to kind of maybe reshuffle, if someone leaves the picture. And then the second one that we're going to talk about today is a cross-purchase agreement, which essentially is identifying, 1, 2, people to interact with. We're going to show you some pros and cons of each of those two. But second to just having the structure there, you have to work out the financing. How is either the business or how are you and I in a cross-purchase agreement, how are we going to make the funds available so that way that business can transition from one to another. The last thing that a company wants to do is to put really too much pressure on itself. Or the last thing you want to do to me or I to you is to put too much pressure on each other personally when it comes to financing. So we'll talk a little bit about using cash, maybe borrowing, how people use installments, or a really common one, which is the use of life insurance.
I would probably caveat our presentation today in saying that because we're wanting to limit the presentation today, we could probably have an entire meeting on financing and explore the advantages and disadvantages of the financing methods. We are not going to go into great detail on financing today. I think we'll spend most of our time talking about the two different types of agreements. And so the first type of agreement is a cross-purchase plan. And that this particular slide, I'd have you focus on owner A on the left, owner B on the right, and the company at the head of this slide. Really what you're doing with a cross-purchase, and this is an agreement, the your and I's agreement is a cross-purchase agreement. In the event of either one of us passing away, congratulations, Zach got married in June. He's got a wife to protect. He has a business value in his ownership. In the event of his death, I would directly buy his stock, and his wife would have the proceeds of that sale. And conversely, he would directly buy from me my stock shares. As opposed to, and again, that's what this diagram is meant to describe, as opposed to a stock redemption agreement or an entity agreement, which means that the company, and you first started to describe this, the company itself would actually be redeeming, and let's say if you and I had that agreement, our company would actually redeem my stock in the event of my retirement or my death or disability. And you might have 50 shares and I might have 50 shares, making us equal partners. But in an entity agreement, you literally, my stock would get redeemed into treasury by the entity, and you still own 50 shares. And I think the primary advantage or disadvantage, again, comes back to the tax aspect. The entity or redemption agreement has a different tax effect than the cross purchase, simply because of what we do, whether we do treasury stock or whether you acquire my stock. if that makes sense.
Yeah, just
You want to elaborate on
yeah,
that?
just kind of on the personal level, right? If I transact with you directly, that second bullet under the advantage, that tax benefit is if you were to pass away, you get a step up in basis from your cost original, or different from the original cost of your purchase. The same thing works on if you don't pass away and I just buy your business. I mean, I'm buying that business, I'm paying, and now that is my cost basis.
Correct.
That I get to, start depreciating myself. When we're working at that individually, we can use those tax benefits, to your point. But when you get outside to that entity agreement, when the company, and this is what you were alluding to as the treasury stock, is buying the shares, you actually don't really, that tax benefit kind of goes away. There is no cost basis or step up.
We get a lot of business owner clients, and maybe their first buy-sell agreement is an entity or a stock redemption agreement, because it is a little simpler in concept. It's also easier for a business to use the assets of the business, especially if you're having to buy insurance or something like that. The company assets feels better to use the company assets to buy an insurance policy and redeem my stock in the event of my death. It works. It feels good. But again, you have to consider the long-term impact of how that affects cost basis for you and the surviving partners.
Yeah.
I would tell you a very good reason to do a redemption agreement is if you have a family business that's been in the business for several generations and there's absolutely no intent to sell. The entire family, or it doesn't have to be family.
The key persons that are
the people and the shareholders of the company have no intent to sell. They intend to operate this business. They're going to stay in this industry, fully committed. The future is bright. You can use an entity purchase and not necessarily worry about whether you gain step up in basis at death or during lifetime, because the income tax benefits, are not going to play in to the ultimate purchase. So that's probably one key reason to use an entity. And as I mentioned at the beginning, it's probably the first buy-sell agreement most clients do, and it's probably one of the more common at the initial phase. But then people will progress to a cross purchase a lot of times because they do see, an income tax.
Yeah, whether it's the income tax benefit or like that first bullet, it's a little bit more clarity, right? It's a little bit more simpler when you and I are maybe in business together, and you can easily throw another, third or fourth person, and we want to stay in business together.
Sam is on his youngest brother.
Sam, are you listening? Yeah.
He's on the call. I saw him pop on, so he's considered the.
Yeah. So when you and I, can very clearly state that we want the business to transition this way, we want the stocks to go to this person. Let's bring another person on board, and that stock goes that way. I mean, I think that's one of the biggest advantages. That stock is being transferred directly to those people. It's not going into treasury. So there really isn't kind of that limbo of, hey, in your example earlier, we each own 50-50. Yeah. I still own 50, and now your 50 goes up into the company treasury. Like, that can still get a little bit confusing, to some people, or if there's multiple parties involved.
Yeah, let me give you a specific example. Last year, we were working with a client that had 4 owners. Each of those 4 owners happened to own 25% of the company, and it doesn't matter what the percentage is. But that third bullet point on the right under disadvantages, they had an entity purchase agreement because of the complexity of trying to figure out how to have 4 owners do a cross purchase. You and I can do a cross purchase, and they had funded with life insurance. Again, that's neither here nor there. But when you're using life insurance, and it is very common, I can have a policy on you, you can have a policy on me. Simple enough. But if there are 4 partners, do I have to have a policy on you and the other 2 shareholders as well? And you have to have a policy on me and the other 2 shareholders. And then owner C has to have a policy on 3 shareholders. Yeah. You start to get into dozens of policies with 4 or 5 owners. And so that complexity, people throw up their hands and they say, well, we can't do that.
And that's to take that a step further. I mean, the cost of that insurance, I mean, for you and I mean, the cost of insurance between us is going to be a lot different. I mean, whether it's just as simply as age or health or things like that. So throw in, dozens of policies, throw in one owner being much older or in a different, maybe one has smoked in the past or had, unfortunately, a cancer diagnosis, whatever it may be. I mean, it can be pretty tough to find that fair value, as we call it.
I like the idea because you're young and
Yeah, I'm
helps,
sure you
but
do.
You'd
Yeah.
be a really cheap policy. On the other hand, might be a little more expensive.
Yeah.
So anyway, we can, obviously your legal team, your CPA, your financial advisor can help you sort through those complexities. But I would suggest, and again, I don't have a slide for this. Again, this will be an advanced topic. And I want you to write this down if you have a cross purchase or if you are in this situation with multiple owners. In that case, what we would use is a trusteed cross purchase. And what you want to do is you want to think of a trusteed cross purchases, much like when you sell a home. If I bought a home from someone specifically, we've all kind of done that. You don't just give a check to the person.
Yeah.
What you use is an escrow agent. That escrow agent takes the check, makes sure the contract is executed properly, and then distributes the check. There is no income tax impact to the escrow agent, but a trustee cross purchase works that same way. You can use your attorney, you can use a trust department, you can use your CPA, but that person acts as somewhat of an escrow or intermediary to simply have one policy on each owner, so that in the event of that person's death, the money comes in, the escrow agent uses it to execute the agreement according to the instructions of the remaining shareholders. So jot that term down, trustee cross purchase, if you're in that more complicated situation.
Yeah.
We talked about the stock redemption agreement a little bit, and that is a different style of agreement in which the company redeems the share in the event of someone's death. We can just kind of hit the opposite side of the opposite side of the equation,
Yeah.
some of those advantages and disadvantages.
Yeah, I mean, I think it's a little bit simpler from the aspect that, the company is the only one that stays involved, like you mentioned. When you get third parties involved, like buying out spouses or things like that can just kind of muddy the waters a little bit. Not in a good or bad way, but it just makes it a little bit more simple in an entity agreement to keep everything within the business and only deal with people within the business who actually have a responsibility there. You talked a little bit about, kind of just some of the costs of that. If you're not using life insurance, or maybe even if you are, but when the company is paying out to buy some of those shares back, the interest can actually be deductible.
Right.
To the company.
We take a bank loan, that interest is clearly deductible by the company in terms of making those payments.
Yeah. You talked about the valuation, the formula. It's a little bit easier for a company ongoingly to keep that formula up to date and valued.
Present in mind.
Yep. When you are meeting about it consistently. As long as everyone essentially agrees that that's still fair, if something were to happen, you just essentially apply the formula that everyone has agreed upon. In the opposite scenario with a cross purchase agreement, let's say you're buying life insurance, in year one, but something happens in year 10 or 15, is that value of that life insurance still adequate maybe to what the business is worth at this point? I mean, it's something you did in the past. By using the entity agreement, you're a little bit more forward, focused.
Right. Something that's a little bit more esoteric that falls on the disadvantage side would be, and this is in direct relation to the cross purchase agreement. Again, come back to Zach and I. If I own a policy on Zach, or if I have, a sinking fund or financing money in the bank to pay for Zach's shares and vice versa, in the event of one of our retirements or deaths, I buy you out. Under a cross purchase agreement, you still own the financing or policy on me.
Right.
And so it's a bit more equal. So one of the disadvantages of an entity agreement is if our company owns a policy on you and me, and you pass away, I get the company, but I also get the policy,
right?
Because the company owns it. So I get the whole, to use a sophisticated term, kit and caboodle. I get the whole thing, including your financing, that essentially you helped pay for over the course of using our profits. So I get your company, I get your stock, and I get your financing. And so it can be a little bit of a disadvantage to use an entity purchase, and it can be a little more fair. That's what we mean by maybe more with this unequal coverage or fair relative to an entity purchase. So not to say, and this is one of the things we talked about ahead of time, one of these is not right, one of these is not wrong.
Yeah.
Some companies should be using an entity, some should be using a cross purchase, and therein lies the work that needs to happen with your advisor team.
Yeah.
And then finally, again, folks, thanks for joining us today. This is the last slide that we're going to cover before we open up for questions. But many businesses need to be very thoughtful about the key people around them that are not shareholders. That could mean developing a strategy to make them a shareholder over time, or developing a strategy to compensate them well because you're not going to make them a shareholder.
Right.
And so that's a decision every business has to make. It's a sensitive one. I will tell you, in working with hundreds and hundreds of businesses, as we talk to business owners and as we talk to key people quite frequently, more and more valued employees are seeking equity or something that very much acts like equity in their business. They see it as a key to wealth. They see it as control, which they lack as a key person, just an employee. And again, they see it.
And just the personal growth aspect of it too. When someone looks like how they want to, grow over time, really that can be, important to them.
Yeah, but ultimately that comes down to security.
Yeah.
Every person in the world wants security in their future, in their career in particular. And so you as a business owner have to address how do we either transition stock successfully, or how do we compensate that person without transitioning stock? Because many business owners have very, very deep-seated feelings about whether to share stock or not share stock.
Sure. Yeah. So there's different, like a deferred compensation plan. There's different things you can do maybe within the 401k and things like that to reward people. There's different kinds of insurance policies that are, out there that can create a benefit, in the particular event, and just different sorts of, equity arrangements. Again, that's just in the meantime that maybe you're waiting to create a partner position or a shareholder position, or maybe that's just not going to be the route, but you want to, reward that person.
Yeah, again, it's a separate presentation at some point in the future, but whether there are plans like a phantom stock. Again, that's similar to an equity incentive. It's not real stock, but that's why they call it phantom stock. You might formalize the plan into something like an employee stock ownership plan. We have a couple of clients on the phone that are really evaluating right now a phantom stock plan versus an employee stock ownership plan. The phantom lets you target the people you want to benefit. The employee stock ownership plan lets you benefit all of the employees to get that consensus of ownership to a certain degree. So again, we've been about 35 minutes in our presentation this morning. We wanted to kind of try to keep it to about 30, leave room for questions. I would close with a little bit of an incentive. If your business, I feel like a lot of businesses have either not developed a formula for their business, or they developed a formula and they're not sure that formula still applies because it hasn't been addressed in a few years. One of the advantages I felt like we've always had by being one of the largest independent broker dealers in the country is we have great relationships with some of the advanced planning teams on some of the largest insurance companies in the United States. We work frequently with one of those companies. They offer a free service where they will take 3 years worth of finances from your business, again, financial statements and tax returns on a confidential basis, and they will do a preliminary valuation that looks very much like this. These 4 approaches, they will give you a complimentary preliminary valuation just to give you kind of a watercolor painting of what the value of your business might look like. It will also contain the formulas by which each of these have driven. Now, it's not the final answer, but it might be a great starting point for you to invest no money and a little bit of time to be able to get a sense for where your valuation currently stands, or is it fair compared to the formula you currently do have.
Sure.
Then it becomes your opportunity to then elevate to your CPA, to your attorney, to a valuation expert, and talk about that. Anything else you want to address before we go to questions?
I don't think so. I think we kind of covered everything. We wanted to be, relatively simple today and give you some of just the major points. Each one of these slides, we probably could have taken an hour presentation to dive in the deep. So, Kimberly, I think, if we have time to open it up for questions, if anyone wants to unmute themselves, Tim and I can stick around here for a little bit, but I know some of these things are, pretty sensitive too. Our phone number and email address, website is all right there on the screen. So If you have a question that's maybe, you know, too personal to bring up now, you know, please feel free to reach out to one of your advisor here or one of our team members.
Yeah, you can go straight to your advisor, or Kimberly answers that info at InfiniTALKS KC, and she can get you over to one of the specialist advisors if you don't have a financial advisor.
Awesome. I have given everyone the option to unmute. So if you have a question, feel free to just go ahead and unmute and ask. Or if you're more comfortable using the raise your hand feature, you can do that as well. As I said in the email today, we do have a smaller group today, which is going to allow us a lot more time to dive into questions. So please feel free to ask those.
I don't sing and I don't dance. You definitely don't dance. You don't like to dance. So we'll give you just a minute. Again, feel free to email I know these are mostly personal questions in many cases. Today's session was being recorded. It'll be distributed back out to our entire client list. If you'd like a copy of this presentation, simply email info@infinitalkskc.com, and Kimberly will be doing some edits, taking out my bad jokes, and then we'll have that available for you to send out. One last pause here if there are any questions. All right, everyone. Thank you for joining us today. We appreciate your time and attention to this business topic today. There'll be more business and personal topics in the future as well. We look forward to seeing you in the future.
Yeah, thank you all.
Thank you, Zach.
Thank you.
You bet, folks.